Hi and welcome to FreeX Financials. My name is Esteban Ferrarotti and I am lead financial analyst at the company. Today we are going to talk about key performance indicators for property owners, a comprehensive guide to evaluate property portfolio performance. So let's dive into the video. So property performance indicators. Analyzing the performance of your property allows you to make smarter decisions, right? So you cannot make decisions without information. Information is key for decision making. So if you want to make decisions and if you want to make smart decisions, you need smart information. You need great data. That's why you need indicators. So there are several indicators that can be analyzed, which can be grouped in three categories: rent indicators, cost indicators, and profit indicators. So let's dive into these three categories. So first we're going to talk about rent indicators. So understanding the occupancy, rental collection, and market dynamics are crucial for evaluating property success. So rent indicators are the ones that are related to your rent, right? So to the tenant, to the rent, to the market rent. So that's what about in rent indicators. So let's look at these three. So the first one is occupancy rate. The occupancy rate measures the percentage of rented units in a property in case of a multi-door property, or in case of a portfolio with several properties, or you can also view it as the percentage of time one property is rented over the total time. So let's say how many months of the year was rented over the 12 months that the year has, right? So this indicator indicates its desirability and potential income, right? So when you have a property that it's constantly being rented, so you have, let's say, 100% occupancy rate, that means that the tenant, it's first that you have a good tenant, that it's keeping the property, that is there, that it's not going to move out. Then it means that your property is desirable, because I mean the tenant doesn't want to move out, and sometimes when the tenant move out, you find a new tenant just right after that. So I mean, occupancy rate it's a great indicator of desirability, but also of potential income. Why? Because if you have low occupancy rate, that means that you are going to be changing the tenant all the time, and that will bring a lot of turnover costs, that are costs that you want to avoid. We talk about turnover cost in the last video. If you want to see it, you can find the link in the description below. But turnover costs can be really harmful for a property performance. The other indicator related to rent is collection rate, right? So the collection rate reflects the efficiency of rent collection, highlighting potential cash flow issues or tenant management challenges. So maybe you have a tenant that is interested in keeping your properties, but maybe he's like living paycheck to paycheck, or maybe, I don't know, he doesn't have a steady job, so maybe 1 month he doesn't pay, and then he pays 2 months on a row, or 2 months together, and there is some debt there. So when you have a 100% collection rate, that means that your tenant is it's a stable person. I mean, has a steady job, can pay you all every month, and that's great. When your collection rate starts to go down, that means that your tenant might not be a good tenant, or it also could be an indicator of a turnover. You know, someone that stops paying the rent, and 2 or 3 months after that you have to evict that person, or pay just a little bit to keep on the property. But I mean, you know that tenant is not good for you, right? So collection rate is another rate performance indicator, that rent performance indicator, sorry, that it's great to look at. And the last rent indicator is the actual rent versus market rent. So comparing what you are charging, I mean the actual rent earned with the market rent rates, provide insights into pricing strategy, effectiveness, and potential revenue increase. What does that mean? I mean, If you're charging, let's say, $1,000 for a property and the market rent is $1,000, that means that you're charging the right price, the correct price. You couldn't get more money for your property, but you are not getting less than what you should be expecting. If you are charging, let's say, $800 and the market rent it's $1,000, that means that you are charging a slower price than the market is. So you have either the potential to increase the revenue when the contract ends and you have a new tenant, or to renegotiate with the current tenant and a higher rent since the market rents have gone up, right? So that's other thing that you have to keep on monitoring always. So some key insights: ensuring high occupancy, efficiency, rent collection, and competitive pricing are key to maximizing property revenue and investment returns, as we saw in the past slides. Second category, cost indicators, analyzing management cost over rent. So management costs play a crucial role in property performance. Understanding how these costs relate to rental income is key to optimizing profitability, right? So, and when we are talking about management costs, we don't refer, or we don't refer just to specifically management costs, like for example, the property manager fees. We also refer to repairs, to maintenance, to administrative costs, everything that is related to managing your property. So, impact of management costs. Management costs, including property management fees and administrative expenses, directly affect the overall income generated from rental properties. Analyzing this indicator provides insights on operational efficiency and financial health. The most property you have, the most opportunities you will find to renegotiate with your property manager his fees. If you are more efficient, you can have less administrative expenses. So the less expenses you have, the more profitable your property will be. So some strategies: implementing cost-saving strategies such as efficient staff allocation or technology integration. Today, you have a lot of technology that can maybe even replace a property manager, can help reduce management costs and increase rental income. Continuous monitoring and adjustments are essential for long-term success in property management. And then the impact of maintenance and repairs. Repair and maintenance costs should be monitored monthly. It's really, really important to monitor repair and maintenance. A property with high repair and maintenance costs can end up absorbing all the rent collected, or even cost the owner to constantly put money out of their own pockets. We saw this in the last video that I mentioned, that is in the description, right? Having a property with high maintenance and high repairs can end up being pure loss for the owner. Strategies to reduce maintenance and repairs costs. To minimize maintenance and repairs costs as much as possible, it is best to have the property inspected by a construction expert before purchasing it. That's the best way to do it. Before you purchase a property, you have it inspected by a construction expert to see if the property will need or not high maintenance and repair costs. But if you already have such a property, look for contractors with whom you can negotiate better rates, considering that you will give them a lot of work. So you can just talk to a handyman or to a contractor and say, hey, I have this property that constantly need maintenance, and I have 2 or 3 in my portfolio that are the same. Could we negotiate a better rate in case I give you the free properties to repair constantly, right? So that is another way of saving costs there. Property indicators. The next one is profit indicators, right? So maximizing property profits. So learn about key profit indicators, essentials for evaluating property portfolio performance. When we are talking about a performance, we are talking about 3 things, right? Sales, so rent indicators; costs, cost indicators; and as a consequence of the difference between sales and cost, you have profit indicators, right? So we will evaluate 3 property indicators. The first one is operational profit. Operational profit is the total revenue generated from property operations, like for example rent or other sources of income, minus all the operational costs such as management costs, repairs, and maintenance, right? So it's everything that is related directly to the property, right? Management costs, repairing the property, maintenance, cleaning, I don't know, exterior. I mean, all those costs that are directly um, directly um, assigned to or allocated, sorry, to the property, right? So that's operational income, operational profit. Then we have net profit. The net profit represents the total earnings generated after deducting all expenses, including financial expenses such as mortgage and other costs like taxes from the total revenue received. So you could have a property that maybe is operationally profitable. Let's say that you have a property that rent covers all the maintenance and management costs and gives you a profit there. But since you are paying a high mortgage, then the property end up having a negative net profit. So the strategy is different in both in different cases, right? I mean, if you have property that is operationally non-profitable, then you have a problem. That property is not suitable for you. I mean, it's not suitable for being rented. Maybe it's a good property to have it as an owner to live there, but it's definitely not a good property to have it or to rent because it's operationally it's giving you an operational loss. But if you have a property that it's operationally profitable, but in terms of net profit you have a loss, then you should evaluate maybe getting a mortgage with a lower interest rate when interest rates are down. We talked about this in our last video. Or you could evaluate maybe how much time till you finish paying all the credit that you or the mortgage that you have, because this property could be profitable in the future if there were no mortgage there, right? Um, and the last profit indicator is the return over investment or return on investment, that is the ROI. The return on investment calculates the efficiency of an investment by comparing the net profit to the initial investment cost, right? So it's comparing the net annual profit of your property against the money that you put to buy that property, right? So that's the return over investment. So evaluating property portfolio performance, assessing the overall performance of your property portfolio is essential to make informed decisions and maximize returns. We saw during this video different cases where having the information can allow you to make smarter decisions, right? For example, if you don't monitor your operational and net profit, and you just know that you're losing money every month, how could you ever know if the problem is the property, the problem is how you finance that property? So I mean, having indicators to evaluate rent, to see if you have the right tenant, to see if you are charging the right rent against the market, having the right indicators regarding cost, to see if that property is efficient in terms of maintenance, in terms of repairs, um, having your property evaluated from a profitability perspective to see if the property is winning or losing money, and why it's losing money. If it's losing money, it's key for making smarter decisions. So that's it for this video. I hope you like it and it's useful for you. Once again, remember to give a like to the like button if you like it, and subscribe to our channel. We will be posting more content related to properties, related to financial management, and all topics related to finance, right? So bye, see you.